What's up, everybody? It is Friday, December 17th. I'm back from Key West. I had a great time, man. That's a cool place. Not my first time down there. I've been there many times, but I don't know. I like it. I like the vibe. It's laid back. The weather was awesome. Anyway, back here in New York City, actually pretty warm here in New York City. Yesterday was 64 degrees. Today was like almost 60. Not bad for December 17th. All right, let's talk about the markets. Mainly I want to talk about, I think what the market is so concerned with, rising interest rates. You got central banks now pretty much around the world raising rates. Some going crazy, some just starting like the UK. The Fed expected to begin next year. And the belief in the market is that or the dynamic that the market is reacting to is rate hikes bringing down asset prices. And I've been telling you that rate adjustments are just price adjustments. And if you think about the dynamic that goes on with rate hikes supposedly bringing down asset prices, and that's also arguable because you could have asset prices sustained in a strong economy. Okay, that's another part of the equation. Economic activity can also sustain asset prices at certain levels or even make them go up. But let's set that aside for a second. The reason why, if you're going to use the argument that rate hikes will bring down asset prices, you have to explain why that is true, if in fact it is true. And the reason why you would, or the argument you would use to explain that, is that rate hikes increase the cost of finance or increase the cost of holding an asset. So therefore, it is a price adjustment. It is an increased cost which cuts into the return on that asset. So there you have it very simply. Like, you can't just blurt out, if you blurt out, hey, rate hikes are going to decrease asset prices, you have to understand the underlying dynamic of why that is happening. Just throwing out kind of like a canned line, oh yeah, rate hikes increase asset prices, like there's no underlying dynamic that makes that work. Well, there is. It's a cost increase. And this has been what I've been telling you for a long time, that rate adjustments are price adjustments, and vice versa. When rates come down, it makes the cost of finance cheaper, okay? So in effect, your rate of return goes up and the asset goes up, reflecting that higher rate of return. So rate adjustments are price adjustments. And once you understand that, then hopefully the whole, boogeyman effect, this fear mongering about rate adjustments should go away in your mind. You should see that for what it is, which is simply price adjustments, and price adjustments are just a redistribution of income in the economy. It goes from one cohort to another cohort. That's why if you're talking about inflation, and I've said this so many times, the income is not lost. It does not fly out into outer space. There's a redistribution of income in the economy. The economy is going to look different, like certain sectors are going to benefit. We saw it very clearly during this inflation spike that producers, oil producers, commodity producers, they liked it. If you're a farmer, and you saw the price of soybeans go from whatever, $8 to wherever it went, $14, $16 a bushel, or you saw wheat go up to wherever, $10 a bushel or corn from $2 to wherever it was. You're loving it. Your income just went up. You're not running around saying, hey, I hope prices crash back down again. So it's just a redistribution of income in the economy. Certain sectors benefit, certain sectors lose. What we have to take into account is when the income is pulled away, when that again, it seems like every single time I use the swimming pool analogy, but that's a good analogy. When the pool is sucked out, either through taxation to the point where the government is taxing more than it is pumping in, okay, that's called running a surplus. That drains out that income. That is very, very negative for the economy. That makes almost all sectors struggle. All right? We're not having that right now. You know, we still have, I mean, the deficit might be down. I got to look at the numbers today. It might be down year over year slightly, but it's still running near record levels. You know, we're going to be talking about a 2.7, 2.8 trillion deficit, you know, something around a 10% GDP, something like that. I mean, that is a significant amount of flow, of net transfers into the economy. So really, you have to understand what the dynamic is going on here. All right? I mean, when you're talking about any kind of rate adjustments, whether it's up or down, it's just a redistribution of income in the economy. Certain sectors are going to benefit from that. Certain sectors are going to be hurt by that. The key thing is to identify who's going to benefit and who's going to get hurt. I mean, clearly when rates go up, debtors get hit, okay? They have to pay higher interest costs. And savers, right, creditors, they make the money. I mean, their income goes up. Just like in the inflation example I just gave you, you know, you have commodity producers, they're loving it because their income goes up. But we as consumers, maybe we're not liking it too much, or it hits us as, you know, a burden because our costs are going up. So that's what I wanted to talk about, because you can't just say, hey, wait a minute, my dog is scratching at the door. I'll be right back. Hang on. Sorry about that. I got my dog in here right now. She wanted to come in. So yeah, that's, hey, come here, Sandy. Get out. Come on, go. In case you're wondering, I got a pit bull. It's kind of a pit bull mix. She's going to be 15 years old, black with white paws, and classic kind of pit bull look. A very nice dog, very friendly. She's in here, right here now, getting involved in this video. So yeah, folks, don't get all panicky and don't get all freaked out. I mean, you have to just understand what's going on here. If you understand what's going on, then, you know, you got to stay calm. First of all, today, the industrials were kind of catching up with the NASDAQ pullback. By the way, the NASDAQ pullback did not take out the December 3rd low. Okay, that's still there, so that's a good sign if you're looking at it technically. Banks, financials got hit today, but that's a good opportunity in my opinion. I mean, we see now in the data every single week loans increasing at the banks, and that's going to continue as the stimulus kind of decelerates. I mean, what happens? There's just a natural reaction by businesses and households to tap into credit more because they're not getting as much of that net flow as they got before, those net transfers. So the banks are going to benefit from that. So this sell-off in the bank, in my opinion, is a great opportunity. It's presenting some great values. I've been saying this for a long time, that bank stocks are probably some of the best values in the market. They're going to earn higher income if the Fed does indeed raise rates. And that's the environment we're in right now. It's nothing to get all freaked out about. It's nothing to get all panicky about. It presents different opportunities. You have to know what those opportunities are. I mean, in general, I see people just like completely, you know, going crazy over this and thinking like it's the worst thing that could possibly happen. It's not. The worst thing that could possibly happen, you know, aside from something really terrible like a war or this virus spreading to the point where everything gets shut down again, is that we have policy, fiscal policy, where, you know, they want to rein in the deficit, they want to cut spending, they want to run a surplus. I mean, that would be bad news. That would be very bad news. But that is not happening, as I said many times before. And that, I mean, look, they just did a new defense bill today, 780 billion new defense bill. They had no problem passing that, which is a little bit frustrating and a little bit maddening, because I would love to see infrastructure. I would love to see more social supports. I would love to see, you know, the free education proposal that was out there. But military always gets the money. You need 14 billion for an aircraft carrier, boom, you got it. You need $1.5 trillion for a jet fighter system, boom, you got it. I mean, there's never asked, the question of how we're going to pay for it is never asked when it comes to military spending. We saw that again today. We saw all the problems in passing the Build Back Better, you know, how that was going to cause inflation and this and that. But you need 700 billion, you know, new military budget for this year, which is, I think, something like 4 or 5 times more than the next 4 or 5 countries combined, or more than the next 4 or 5 countries combined, how much they spend on defense. Boom, you got that money. There's never any questions asked about that. So, look, you would have to cut Social Security, which is not going to happen. You have to cut Medicare, which is not going to happen. You have to cut Medicaid, which is not going to happen. And you have to cut defense, which, here's the example today, they just raised it. So that's not going to happen either. So the 4 big pillars of government spending, they're not going to get cut. And so we're not going to see any a significant curtailment in the fiscal flows. It's going to, you know, throttle back a little bit from where it was in March of 2021, but it's still strong enough to support a very decent economy. Let's hope we get through this virus situation, this new outbreak, and you know, I think everything's going to be fine. Anyway, that's it for today. I hope you have a great weekend. I'll try to get a video going on Saturday. See ya. Bye-bye.